Hi, I'm Dr. Cheryl Dunn, and in this video I will demonstrate how to calculate the prices of a bond. When a company needs to borrow money, sometimes they issue bonds. We also call that selling bonds. So they sell bonds to raise money that they will then have to repay. The bonds are represented by bond certificates, and on the face of the bond certificate, various terms will appear that form a contract. And so the company will sell these bond certificates, and by selling them, it is agreeing to honor the terms that are on the face of that certificate. Those are not subject to change. The face of the certificate will have a principal value that will need to be repaid at the maturity date of the bond. There will also be interest payments that need to be made, and it will give the face interest rate or stated interest rate at which those payments are to be determined. The principal value and the interest payment amounts cannot be changed. They are set in stone by what's on the face of the certificate. If the interest rate that the company is paying on their bonds is not the same as what the market demands, then because the face of the certificate can't be changed, what does change is the price of the bond. So we're going to look at a bond here, and we're going to see what happens if the market is demanding a higher price than what the bond has on its face, versus what happens if the market is demanding the same interest rate as is stated on the bond, versus what happens if the market is demanding a lower interest rate than what's stated on the bond. So take a look at the problem. Okay, so you can see that the face value of the bonds is $420,000. Our company Flip and Rod is borrowing this $420,000 from various individuals or companies that trade in the bond market. These bonds are 10-year bond, and they pay interest, and the payments are made semi-annually, which means there's a 3% semi-annual interest rate associated. If you take the annual interest rate and divide it by the number of periods that there are in a year, and when it's semi-annual, there are 2 payments in a year, just like there are 2 semicircles in a circle. So semi-annual interest rate there would be 3%. That's on the face of the bonds. We are asked then to calculate the price of the bond, assuming that the market interest rate is 8%, or 4% would be the semi-annual interest rate in that case. Let's start by making ourselves a timeline of the terms of this bond. Basically, it's a 10-year bond, which means there are 20 semi-annual periods. And at each one of those periods, so we'll start with 1 being the first 6 months, 2 being the second 6 months, and so on and so forth, all the way out here to n equals 20, being the 20th 6 months, which ends the 10th year. At each one of those payments, the company is going to pay 3% of $420,000, which is $12,600. So if we take that $420,000 times 0.03, that gives us the interest payments that are made every 6 months. That does not depend on what the market interest rate is. That's based on the face of the bond. And so every 6 months, according to the contract that they made when they issued those bonds, they will pay $12,600 in interest. On the very last payment date, they will also then repay the principal of the bond, which is the face value of the bond as a whole, which is that $420,000. So this payment, set of payments here, is what we are trying to put the price on using the market interest rate. And to do that, what we're going to do is we're going to calculate the present value of these interest payments and principal payment at the market interest rate. Now to do that, the first thing we need to recognize is that the interest payments form an annuity. And that's important because if we didn't recognize that, we would have 21 different payments that we would have to calculate the present value for, and that would be somewhat tedious and arduous. But when we recognize that the $12,600 is a series of payments made at equal time intervals and of equal amounts, that meets our definition of an annuity. And that means that what we can do is take the present value of an annuity factor at the market interest rate, and here the market is demanding that 4% semi-annually, and n equals 20. If we find that factor from the appropriate present value table, we then can multiply that factor times the $12,600 to get the present value of the interest payment stream. And so if we look in that table, we see that factor is 13.59033. If we multiply that factor times the $12,600, that's going to give us $171,238.16. We then take the present value of a dollar table, because the $420,000 is just a single amount. So we're going to take the table that's set up just to find present values of single amounts, and we're again going to use the market interest rate, semi-annual interest rate, and the number of semi-annual periods, which in this case is 20. The factor in that table for those that interest rate and that number of rows is 0.45639. We multiply that times the $420,000 principal balance, and that's going to give us the present value of that payment that's made at the end. And that's going to be $191,683.80. We then add the two of these together to get the total present value of this bond's payments that are being made. And if we add those together and round to the nearest dollar, we're going to get $362,922. So that is the price at which this bond will be issued. The journal entry we would make, which is what the question asks for then, along with the bond price, we're going to receive cash equal to the price of the bond. So we will debit cash for $362,922. However, when the bond comes due, we are going to have to pay back the $420,000. And so we're going to need to credit bonds payable for that full amount. What we do with the difference then, which is $57,078, is we debit an account called discount on bond payable. This discount on bond payable is what we call a contra liability account. It reduces the value of the liability, or it goes against the liability. The idea being that if we were to turn around and go back out on the bond market the very same day, as long as the bond market interest rates haven't changed, we would be able to buy back our bonds at the same amount that we sold them for. And so the net value of the liability then is equal to the issue price on the same day it was issued. And then over the life of this bond, this discount is going to be distributed or turned into additional interest expense. I'll have another video that will show you how to do that if you're interested, but we're not going to do that in this problem because we're not asked to. So this is the journal entry we would make for Part A. For Part B, we're given a scenario where the market rate is 6%, which is the same as what the stated information for the bond is, or what's on the face of the bond certificate. The bond is already designed to generate 6% interest, and so if the market is demanding 6% interest, they're simply going to pay full price for the bond. We don't need to make any calculation for the issue price of the bond. And so we'll just say that when it's issued at the market rate, the price is the $420,000 face value. The journal entry we would make then would simply be to debit cash for $420,000 and credit bonds payable for $420,000. There is no discount, there is no premium, because the market was willing to pay exactly what we were asking because that was the rate that they were demanding. Now we move on to Part C, and Part C says assume that the market interest rate is 4% annually, which is a 2% semi-annual interest rate. In that case, everybody's going to want to buy this bond, because if we're offering 6% and they're only demanding 4%, everybody's going to want to buy this one instead of the other average bonds that are out there in that market. That's going to drive the price up. So we're going to end up being able to sell these bonds for more than their face value. And when we do that, we call that a premium. So we say we're issuing the bonds at a premium when we receive more for the bonds than what the face value is. To figure out how much more we're going to get, we're again going to find the present value of these payments here, but this time using a market rate of 2% semi-annually. So we're still going to go to the same tables as we used before. We'll get the present value of a $1 annuity, and we'll find this time the factor at 2% and n equals 20, and that factor is going to be 16.35143. We multiply that times the $12,600 interest payment from up here, and that's going to give us a total of $206,028.02. We then find the present value of the principal using the present value of a dollar table at 2% and n equals 20. That factor is 0.67297. We multiply that by the $420,000 principal amount, and that gives us a total of $282,647.40. If we then add the present value of the interest payments to the present value of the principal, we get the present value of the overall bond issuance, and that's going to be $488,675. That's rounded to the nearest dollar. When we make our journal entry then, that's the amount of cash that we're going to receive. So we would debit cash for $488,675. We're still only going to have to pay back the face value at the end of the bond's term. So we're still only recording bonds payable at $420,000. We received more cash than what we're going to have to pay back. In essence, it's as if the bond investors are prepaying us or giving us a prepaid refund of some of the interest that we're going to be giving them later. And it makes it, in essence, that the bond is paying the interest rate that they are demanding. So even though it's paying the 6% rate and they're only demanding 4%, because they paid more for it, it's as if they are effectively will be earning the 4% that they're demanding. That's where the price will stop, where they'll stop overbidding each other is when it reaches that stage. The difference here then is called a premium on bonds payable, and that's going to be recorded for $68,675. The premium on bond payable is an adjunct liability account. So it's an additional liability. If we were to go out on the bond market immediately after issuing this, we would have to pay back $488,675, which is the total of the face value plus this premium. But if we hold it to maturity, we only have to pay back the $420,000. So now you can see if we issue a bond at a discount, we're going to receive less cash than what we have to pay back. And that's a result of the fact that we're not paying a high enough interest rate for what the market demands. And so they basically takes that extra interest right up front by giving us less than what we're going to have to pay back. We then are going to need to spread that out over the term of the bond, but that will be done in another video. On the other hand, if we issue the bond at the exact same interest rate as what the market is demanding, we won't have any discount or premium, and the bond will issue at its face value. And then we showed that if we're paying a higher interest rate than the market demands, everybody's going to want to buy our bond. They're going to drive the price up so that we receive more for the bond than what we will have to pay back. And that difference is called a premium, which is an adjunct liability. Thank you for viewing this demonstration, and I hope you found it helpful for calculating bond prices. If you are interested in how to account for these discounts and premiums over the life of the bond, then look for another video on Flip and Rod Inc., in which I will continue this example to do that.